We're talking about private investment in public equity, public companies, pipes as we call them here. What exactly has been the trend line for participation in these types of deals?
Well, basically what we have been reporting is that there has been a lot of almost $8 billion worth of these pipe deals that's been announced since the pandemic began in mid-March. And that is a result of the amount of dry powder that private equities are sitting on. And because of that, we're seeing a very fierce competition when it comes to these pipe deals. You know, the IRRs have gone down to like mid-teens to 20% versus the 30-40% in the past. And we sometimes see 20 private equity firms going after the same pipe. And a lot of companies, so the ones that we know, Cheesecake Factory, Expedia, have all announced these offerings, and some of them have attracted very many suitors.
So the I guess precedent for all of this would be when Warren Buffett and Berkshire Hathaway basically helped Goldman Sachs with this $5 billion investment, and it was preferred equity, and they got a nice dividend and everything. Is that kind of what these PE firms are all looking to emulate? That would be their home run, something like that?
Yeah, the 2008 Warren Buffett-Goldman deal was kind of like a classic type playbook for a lot of private equity firms. A lot of the private equities are looking into replicating that kind of return that Warren Buffett was able to create in that deal. There was definitely also an element of FOMO in the last crisis. Some private equity might have seen it as if they had to deploy more capital, they could have gotten a bigger return. So there's definitely an element of that. But that's also private equity firms are looking at these deals because there's an absence of leveraged buyouts right now because of the credit market. Instead of taking companies outright, they are taking minority stakes in companies, hoping that by the end of the crisis, when the companies go back to normal, they have a stake or perhaps a board seat in the company.
Yeah. So Crystal, though, that's the interesting part of this, because I'm wondering, suppose some of these deals don't work out quite as planned. I mean, we're talking about names like Wayfair, Cheesecake Factory. These aren't quite the same quality of companies that Buffett was sort of eyeing back in the day. So I'm wondering that even with these sort of minority stakes in these companies like that, does it put these private equity firms in a position where if things do get worse, they're not going to have any choice but to do some sort of a buyout in the end run?
Well, once they have the pipe in, they're already a familiar investor in the company. But also note that like Cheesecake Factory, Expedia, some of these companies aren't really the distressed type of company that we're looking at. I think when private equity invests in these companies, there's hope that by the end of the pandemic, there will be some normalcy and there will be business going back to usual. So it's a variety of profile of companies that are getting these investments, and it's not necessarily that these are the companies that like desperately in need of rescue financing. But yeah, it's a variety of those deals going.
Crystal, are there instances where raising funds through the public markets makes more sense than going through private equity, where companies had the option to go with private equity but decided they were better off just doing it through the public markets?
Definitely. Carnival, which raised $6 billion in the public market, actually spoke to Blackstone for financing, according to our reporting. When companies, explore financing options, they usually look to the public market as well as the private market. The public market usually, they're effective and they provide sometimes more attractive terms, but these opportunities in the public markets aren't always available to certain companies, especially those that are hit by the pandemic harder than the others. So private pipes became an option, but in Carnival's case, they eventually went out to the public market and raised $6 billion instead. So it's very much like a dual track process where they assess and just go for whoever that pays more.